Good afternoon from Cape Town and welcome to our webinar on prescribed assets. My name is Paul de Waal, Senior Advisor for Carrick Wealth, and as most of you know, Carrick is a boutique wealth management company specializing in integrated financial advice. The subject of prescribed assets is very topical at the moment, and the mere mention that government is considering changing regulations pertaining to prescribed assets has led to a heated debate and accusations about crooked politicians planning to grab our pensions and investments. Adding further fuel to the fire, to name just a few, is our current perception of state-owned enterprises and their mismanagement, the recent South African downgrade and its impact on government bonds and foreign investment, and the steady increase of our debt to GDP. So the question arises, should we be concerned about prescribed assets? Here to help us through these muddy waters is Rob Enslin from Strategic Capital and Jaco van Tonen from 91, previously known as Investec. Rob is the Director of Investment Management with Strategic Capital and is one of the investment committee members for the discretionary portfolios used by Carrick Wealth. Rob and his highly qualified team guide us through our portfolio construction for the local as well as our global portfolios and is instrumental in the success of our managed portfolios. Jaco is the Director for Advisor Services with 91 and has been with 91 since 2009 and now heads up the Advisor Services for South Africa. Jaco serves on a number of board committees of ASISA, which is the Association for Savings and Investment South Africa, and interacts regularly with the FSCA board. Rob will be giving us some insights into the history and definition of prescribed assets, after which Jaco will walk us through what will be required to implement prescribed assets, the challenges government will face, and their formal position and timelines on the matter. This will be followed by a Q&A session where our guests will answer your queries to the best of their abilities with the information currently available. We will attempt to keep the presentations to the allotted 35 minutes, allowing for about 15 minutes of questions, which will be handled at the end of the presentations. So without further ado, Rob, over to you.
Good afternoon, ladies and gentlemen, and just from my side, I just want to thank all of you for making the time to listen to our presentation today. Before I continue, just in terms of basic formalities, our disclaimer, I think it's important that you view today's presentation more from an information perspective, and should you have any questions, we strongly encourage that you make contact with the advisors at Carrick to discuss your specific needs. Right, with that behind us, I think headlines like "Are prescribed assets South Africa's only option?" have certainly made their way into the media in recent months and has caused a lot of concern and questions amongst investors as to whether the ANC-led government will make use of prescribed assets as a policy tool. I think it must be said that the ANC has, however, suggested in recent months and weeks that they are moving away from this idea. And today's presentation is really just about unpacking what is myth from reality and describing prescribed assets in a little bit more detail to you. So to kick things off, where does this notion or this origin of prescribed assets that we've listened and heard in the media in recent months originate from? And it really comes from the ANC's January 2019 election manifesto, where a single sentence made reference to prescribed assets. So just to read that sentence to you in a little bit more detail, sentence suggested, investigate the introduction of prescribed assets, and that's the word I'm talking about, on financial institutional funds within a regulatory framework and socially productive investments and job creation, whilst considering the risk profiles of affected entities. So as I mentioned, that happened around 18 months ago, and since then the media has picked up on this and certainly caused a lot of questions amongst investors. I think before we move on any further, probably a good point is just to actually describe what are we talking about when we talk about prescribed assets. So prescribed assets refers to assets whereby policy by government, they change legislation to force pension funds, and it's not necessarily only pension funds, but in this sense, force pension funds to invest a percentage of their assets in specific investments such as government bonds and state-owned enterprises. At present, many of you may be aware that your retirement or pre-retirement monies, the likes of your RA, your Provident, your pension fund, needs to abide to what is referred to as Regulation 28. So your investment manager or your trustees have certain limitations as to the exposure they can put your retirement money to work at. So by way of example, a maximum of 75% towards equities and a maximum of 30% towards offshore asset classes. I think the big difference between prescribed assets and Regulation 28 is prescribed assets almost forces you towards investing in a specific asset or investment, as opposed to giving you thresholds and not allowing you to go beyond that. So what are we talking about in terms of the addressable market with regards to potential prescribed assets? So South Africa's private savings pool is estimated at around 6.2 trillion rand, and that's according to CISA stats from December 2018. So if you had to compare that to some peers with a similar size economy to South Africa, we certainly have a well-developed private savings pool. Just to unpack that $6.2 trillion in a little bit more detail, really of that around 2.2 trillion is made up of unit trust savings. Life offices hold around 2.8 trillion of that, and retirement savings is the balance at around 1.2 trillion. And then further to that, we can just see where those assets are currently placed at the moment. So roughly $1 trillion with banks, government bonds equally $1 trillion, offshore fixed interest at about $1 trillion, and then equities 3.3 trillion, and fixed property at just shy of 100 billion. So South Africa's history with prescribed assets is certainly nothing or not new to South Africa per se. The old apartheid regime made use of prescribed assets as a policy tool throughout the 50s all the way to the 1980s. And it certainly became an assured source of public funding for the government at the time. During that period, pension funds, retirement funds, and life companies were forced to invest in government and government-associated products or projects. And some of those that may be a little bit more familiar to many of you on this call today would be the likes of the SABC, Sasol, Transnet, and even South Africa's universities. The legislation was put in place in the 1958 when it was described as the Prescribed Assets Act. And during its peak, which is around the 1970s, retirement funds had to invest 53% of assets into government and parastatal bonds. The then PIC had to invest 75% of their assets, and life companies were around a third into government and parastatal bonds. In 1988, a commission known as the Jacobs Committee was put in place just to try and unpack the economic impact on investors as a result of prescribed assets. And essentially led to 1989 what we now talk about as Regulation 28. So there was a change in beliefs or strategy there, and Regulation 28 has changed slightly over the years, but essentially originates back from 1988. Although the current ANC-led government has not made use of prescribed assets as a policy tool as of yet, it's certainly been on the agenda and parts of the discussion throughout their leadership. And sort of the earliest dates that we can track back to this go back to 1994 in the 6th chapter of the Reconstruction and Development Program. So whilst never actually actively implemented by the current ANC-led government, it's not as though it has not been mentioned over the years since their 25-year of leadership. If we then move on to just prescribed assets in other countries, whilst it's certainly not a common tool used by most countries around the world, there are some exceptions and other countries that have made use of prescribed assets. So certainly on the African continent, the likes of Namibia, Egypt, Zambia, Nigeria, and Ghana have made use of prescribed assets. And then parts of Asia, the likes of Malaysia, Singapore, Japan, numerous South American countries, as well as Sweden. I think what makes South Africa's history a little bit different is, other than during times of war, there are no real examples of where private savings were forced into government bonds. And that certainly makes South Africa's history towards prescribed assets quite unique. And then a little bit closer to home, our bordering country, Namibia, is another example of a country that makes use of prescribed assets. At present, around 45% of pension fund money needs to go into government projects and Namibian assets as a form of prescribed assets. So what is the performance of prescribed assets, historically speaking? I think it's fair to say that it's been suboptimal from an academic/economic perspective. In fact, the World Bank refers to it as financially catastrophic. And really major prescribed asset failures lie with the likes of Zambia, Nigeria, and Ghana, where the underlying savings were essentially completely wiped out or went bankrupt during their times of prescribed assets. Similar occurrences have also happened in Latin American countries, and where there is probably a verdict where it has had mild success is the likes of Sweden and a few East Asian economies. And certainly, I think the same can be said with regards to South Africa's history with prescribed assets. As mentioned earlier, the Jacobs Committee was formed in 1988 and looked at what was the economic impact on clients as a result of prescribed assets. And what they found from the report was essentially clients lost out in the 70s a real return of around 8.6%, and in the 1980s about 2.9% of real assets were forgone as a result of this, which, as I mentioned earlier, led to the abolishment of prescribed assets and the introduction of Regulation 28. So hopefully with that, I've provided you with some sense of the history of prescribed assets, both from a South African point of view and what other countries make use of it. And now I'm going to hand over to Jaco, who's going to take a little bit more of a forward view with regards to prescribed assets, and give you a little bit more detail. So thank you for now.
Thank you, Rob. Good afternoon, ladies and gentlemen. It's my pleasure to be with you here this afternoon. So as Rob mentioned, my section is really to touch on the specifics really pertaining to the South African position today, and to talk to some of the questions and issues that have been highlighted in the media that pertain specifically to South Africa and whether prescribed assets for South Africa would be a good idea today, and what are the opportunities, what are the challenges, and what are the alternatives. So maybe what we can start with is kind of summarizing the three things that I'll be touching on today. There's a related topic which isn't specifically about prescribed assets, but it is often roped into the prescribed assets conversation, and that is the recent pronouncements around defining when you can get access to your retirement fund assets if you decide to emigrate from the country. And we will talk a little bit about why this particular matter was met with such vociferous response from some parts of the media, and what the issue really is. Then the second matter we'll talk about then is the concept of prescribed assets in South Africa today, what that means, is it doable, what are the downside risks, and kind of what are the alternatives. And then we will look a little bit at the signals that we've been getting from government and from NEDLAC, which is where government, the private sector, and labor debate these matters together, what the actual feedback is at kind of at a conceptual level about what people are preferring us to in fact look at. So let's get into the very first matter. So a few months ago, there were a number of alarming articles published in the public media in South Africa and carried on a number of major news channels, which basically went along the lines that government is trying to stop you from accessing your retirement money if you are going to be moving overseas formally and immigrating. And that is actually not what that particular piece of regulatory change has been all about. So I think it's important to see that piece of regulatory perspective and see it properly. So what is the matter? What is the issue today? If you issue to immigrate from South Africa today, you can immigrate in one of two ways. Immigration is defined in our regulations as immigration in one of two ways. The one is what they call financial immigration, and that is where you are immigrating from the perspective of SARS seeing you as a South African taxpayer. And there's a series of rules that deal with that. The second one is what they deem to call ex-con immigration, or immigration for exchange control purposes. And we actually have this weird situation in South Africa that you can immigrate in two different ways. Now, that is not ideal for many, many different reasons, starting with the fact that it's obviously massively confusing. but also the concept of immigrating for exchange control purposes has caused big issues in the past because it's made it difficult for people to go and work overseas temporarily and then to return to South Africa. So you have to change your ex-con immigration status, which means that the way your assets are dealt with in South Africa is a problem. You've got to put them in a block grant account historically, and you've got limited access to it. So this whole debate about being able to get access to your retirement fund assets if you immigrate used to be linked to this concept of ex-con immigration. You're immigrating for Reserve Bank exchange control purposes, and the government allowed you to cash in your retirement fund if you were doing an ex-con immigration and take that money with you. Now, because ex-con immigration has increasingly grown, it's grown into something which we don't really need anymore. Financial immigration and how we now tax people who work overseas has really dealt with all of the problems that the government used to have in that space. So they came up with this idea to remove the concept of ex-con immigration because it's so confusing and no one really understands it, which is a great move, by the way. It's very supportive because it makes it a lot easier for people like us to take a job overseas, work overseas for 4 or 5 years, and come back to South Africa, and your assets are still here. Nothing's happened to them. They weren't forced into some other structure, and you could just resume your life and come back and work in South Africa again. So it's generally a positive move to remove the concept of ex-con immigration. The problem is that this access to your retirement funds, if you emigrate, was always linked to you are officially doing an ex-con immigration. So if you're now taking this definition of ex-con immigration away, how do you now define when people can get access to their retirement money on immigration? And that's where this debate started. So this rather aggressive articles that were published over the lockdown was in response to government making a proposal to say, listen, we all agree we have to take ex-con immigration away, but now we sit with a few of these things on the side that were all linked to ex-con immigration, and we now need to link them to something else. And so they came up with this idea that you can immigrate, and if you have moved overseas, your tax residency has been moved overseas for 3 years uninterrupted, that only then you can get access to your retirement funds, because obviously government's worried now that people will fake immigration for 6 months and then get their retirement fund assets and then just come back to South Africa. So they're kind of trying to find a workable solution. That proposal of a 3-year rule linked to tax residency is not a great rule. So it was proposed as a draft. Industry and a number of the committees that our company was involved in and many other firms in South Africa were asked to give comment on it. We all gave very much the same comment, which is that's the wrong way to solve the problem. We already have great tests for ordinary resident and physically resident and present that are used in South African tax law, and that should be more than enough to deal with this matter and to decide whether someone can actually take their retirement fund assets because they are immigrating, or whether they're merely moving overseas for a period of time, but they intend coming back to South Africa. And that, ladies and gentlemen, is really the main issue that's, to my personal opinions, been blown out of proportion by some parts of the media, where some writers have had some, I guess, vested interests in trying to talk people into immigrating faster. It's definitely not the government trying to hold on to retirement fund assets so that they could bring prescription in and try and get to your retirement fund assets in some way. Those two matters are clearly not linked to each other. So that's the matter of immigration for exchange control and the link of that to being able to access your retirement fund assets. It's a complicated matter, and I think that's why it was so easy to tweak the messaging to become a little bit alarmist, which really was unnecessary. So then let's deal with the second matter, and let's talk about prescribed assets as Rob described them and explained the history of prescribed assets. What have we learned from that history that Rob had painted, and what does that mean for South Africa? So I'm going to start here at the top left. I'm hoping you can see the little hand there. One of the first important impacts of a program of prescribed assets in any of the countries that Rob had mentioned, but specifically in South Africa when it was used here, is that it distorts the price mechanism in your bond market. In other words, your bonds are no longer really reflecting the credit risk and the long-term interest rate cycle in your country. Now, some people might say, so what? Well, actually, that is a big so what, because the price discovery mechanism in the bond market is critical for your what we call the yield curve in future. Now, those of you who've been involved in project financing would know that if you embark on a 3 or a 4 or a 5 year project in a company, and you want to spend a lot of money to build a big factory or a big establishment or a new property development, one of the key assumptions in the financial model for that program is what future interest rates and inflation is going to look like. And your yield curve, which is really the pricing of your bond market, is the main input into that decision. What the interest rate cycle is likely to look at, what borrowing costs are going to be, and therefore, does it make sense for me to spend the money to build this factory or build this big property development, or does it not? Now, if you start messing with that yield curve, it means you start messing with this financial model, and the people who are trying to make this plan and decide whether they will be able to afford the project, you are now making it more difficult for them to come to a clear answer. So what happens is that uncertainty increases the borrowing costs in your country. The minute banks are uncertain about what future inflation and interest rates are going to do, and you go to them for a loan for a project, they are going to charge you a higher interest rate, a bigger spread is what we call it. And that is a reflection of the uncertainty that's been created by the program prescribed assets and the uncertainty that that's created in the bond market. So that has a very direct effect, not just on the investment returns of asset classes, but just on the investment capacity of your economy. It just means that lots of projects which are probably financially viable might now not be executed because there's uncertainty and there's a lack of confidence. Rob showed the impact that prescribed assets had on investment returns for people who were subjected to it in South Africa in the 60s, 70s, and 80s. And so the purplish box here summarizes that the poor returns on some of those asset classes are in essence a stealth tax. And so it means you end up poorer as an investor. I think that's the part of it that we all understand. If your retirement fund is forced to invest in suboptimal assets, your returns will be lower, and that's like a form of a tax that government is levying. And the last section that we learned here at the bottom is the destruction of investor confidence by this prescribed assets campaign. The undermining of investment confidence incentivizes what we call avoidance activity. And this means that people will simply start investing their money in a way to avoid the prescribed assets program. If they believe that the program is going to be a stealth tax program, they will start taking active steps to place their money somewhere else. They'll stop saving for retirement. They'll, invest that money in something else rather. And the more open your economy is, the more your investors in the economy are able to find loopholes and invest in ways that makes their money not subjected to the prescribed assets. So we definitely saw all of these activities when we had our previous kind of foray into prescribed assets. So let's take those learnings and then overlay them on the economy today. So if we look at the South African economy today, and I'm going to start on the left of the slide at the top here. Firstly, international investor confidence is critical for our economy. In the 70s and 80s, when we had prescribed assets, we also had sanctions. We needed prescribed assets in the 70s and 80s because we couldn't get foreigners to buy our bonds to, in effect, fund our budget shortfall. We were in all sorts of wars. We were the outcasts of the world. No one wanted to invest in South Africa. So all of the projects that were happening in South Africa in the 70s and 80s had to be funded by our own economy. That is not the situation today. Today, a substantial part of our economy is funded by foreign direct investment. And foreign direct investment is all about understanding whether you bring your money to the country, you invest it in South Africa, you get a decent return, but if you're unhappy with your return, you take your money and you go away. That's what the core of investment confidence is. And if you undermine that confidence, then clearly you undermine the willingness of investors to invest in your country. So that's the first important point here, is we must always bear in mind what any big government policy strategy impact is going to be on investors overseas who buy our bonds in South Africa. The second big difference or clear characteristic of today's economy is that the retirement asset pools that all of the people on this call, and myself included, are invested in are a lot more mobile than they were before. In the 70s and 80s, retirement fund assets were completely locked down. You couldn't access your retirement fund. Even if you changed your job, you weren't even paid an actuarial value in the 70s and 80s. You just lost your pension benefits. And then when you went to another company, you had to build it up again. Today, that's not the case. Today, we have full line of sight of our retirement fund assets. And when we move employment, the assets go with us. And more than that, when we move employment today, we have the option to cash in our retirement funds, pay tax, and take the money. So clearly, retirement fund assets are much more mobile. And if government does anything that makes retirement funds appear poor value for money for investors, they will see investors taking active steps to remove money from retirement funds. That is a very, very real potential outcome in South Africa. The third key difference today, if you compare our economy today compared with 20 years ago, is our exchange control, whilst still being there, is substantially more relaxed than it was in the 70s and 80s. In the 70s and 80s, you could essentially not take money out of the country if you were a South African investor. The money was all stuck and locked in here. Today, you can take R1 million without asking permission, and you can take 10 million rand per person if your tax affairs are in order per annum. That is a substantial amount of money. So again, that means that the money could run away from South Africa if, for whatever reason, government takes a step that makes the investment environment in South Africa substantially less attractive. And then the last factor here at the bottom, which is a characteristic of today's retirement fund market and the economy, is that pensioners today are much more educated about investments in general. If you think about your parents potentially who belong to an Eskom or a Transnet pension fund and retired in the 70s and 80s, they understood a lot less about how pension funds work, what investment returns are, what you should be earning and what you are earning. So the informed consumer is much more able to figure out that they're being taken for a ride or they've been sold a dead investment. And so it's much more difficult to pull off a stunt like this in an environment where people can see the impact of the government strategy and where they can actually take steps to try and avoid that outcome. So if we take these four key components about how the SA economy looks and works today, what that means if someone wants to implement prescribed assets in South Africa is, I think it means one of two things. Firstly, I think if you're the government of the day and you try and bring prescribed assets into South Africa, you will find that that asset pool that you're targeting, that retirement fund asset pool, will vaporize literally in front of your eyes. People will take steps to remove money from that system and they will stop contributing to that system. And then the money that you thought you'd have available to invest in all of these projects will essentially disappear. So that is a very real possibility. And we saw examples of this earlier on with union funds a number of years back when government was trying to make changes to the benefits that union members could get from their retirement funds. And large numbers of union members resigned in big, vast groups to cash in their retirement funds before the government regulation was going to come into place. And eventually government just stepped away from that regulation change because they realized that they were doing more harm than they were doing good. So that's the first key takeaway. The asset pools are going to run away. The second thing is that the damage to investor confidence that a message like prescribed assets will send will be a big negative for international investors. It will, lead to a large destruction of investor confidence. And many international investment firms will stop buying South African bonds, which will be a disastrous impact on our government finances because we all understand how fragile our government finances are at the moment, particularly post-COVID, and how it is mission critical that we get foreign investors to help us fund our budget deficit as a country. We do not make enough money from taxes, nowhere near enough, and the gap has grown so large that we need a substantial amount of foreign investment to be able to bridge that budget deficit. So if we damage investor confidence and overseas investors are not keen to invest in our country, what we will lose on our budget will be a lot more than what we think we will be able to gain from the prescribed assets campaign. So one also needs to box smart, and I think it's clear from some of the interactions that we've had with especially Treasury that they understand these nuances incredibly well, and they realize how fine the tightrope is that they need to walk in this case. So then what are the pronouncements? So if we kind of agree up to this point that prescribed assets as it existed in the 60s, 70s, and 80s was a bad idea then and will be a completely disastrous idea today. It won't just be a bad idea, it will be a terrible idea today, and it'll be a much worse outcome than it was in the 60s, 70s, and 80s. If most people are then in agreement on that, then what are we then talking about? What are we going to be doing with retirement fund assets to help stimulate and grow the economy? And there's been a lot of conversation about this, particularly at NEDLAC, where Labour and government and the private sector engages on what we can do to grow the economy together. And so I think the first point I want to make is at NEDLAC, there's a clear recognition from the people who understand the economics that there are huge risks in prescribed assets. And so that going down that road will be disastrous. So what the focus has shifted to then is to kind of ask another question, which is almost similar, but different. And that is to say, okay, but then why is it that outside of government bonds, South African pension funds invest a very small amount of money in long-term projects that have a beneficial impact on our country? And if you look at the South African retirement fund industry, the one place where we definitely do less than other countries, other good, healthy countries where the projects work well, is we invest less in private sector long-term infrastructure. In other words, where the private sector makes money available to pay for the expansion in the electricity grid, to pay for electricity generation, to pay for additional water storage and purification, to pay for road systems like toll systems, to pay for rails and ports. In other words, these are all infrastructure components that are critical to the successful functioning of the economy, where there's a culture that people will pay for the service. And therefore, if you can mobilize private sector capital to provide the funding to improve those infrastructure components, you will be helping the economy to grow faster. If we think about electricity as just such a prime example at the moment, every economist will give you a number as to how much of our GDP in South Africa we are losing simply because we do not have adequate electricity. The industrial growth is being limited to a certain number by the fact that we just do not have enough electricity. So if we could use private sector long-term capital to fund some green energy and other related electricity generation projects, and that electricity could be fed into the grid and could be made available for industrial expansion, the economic growth result from that will be significant. And obviously people will pay for electricity, especially industrial corporations. So the people investing in the new plants and investing in the green energy generation plants will be paid for the work that they are doing in the electricity that they're generating. And those will flow through as profits and dividends to the pension funds who have given the capital for the projects to be funded. So that is an example of a good, proper business model that could be deployed, and where retirement fund capital could in fact be used quite fruitfully with a good return on investment for pensioners. So why are we not seeing more of these projects? Well, I think that's the debate that we are having and seeing at NEDLAC. So the government's asking the private sector, okay, so you guys say you've got money, you like infrastructure investments because they're long-term, they're inflation beating, they give the types of returns in other markets that are good for pension funds. Why are you not investing them in South Africa? And then I think the answers to those are fairly clear. I think the private sector is insisting that we need a private-public sector partnership on these projects, where the private sector has control and oversight over what happens in those projects. And a lot of this has got to do with making sure that you've got proper project management expertise that are overseeing the projects. You've got proper technical capacity involved in managing and planning and implementing those projects. And you've got proper financial control so that you can eliminate potential sources of corruption in the procurement and construction processes. Those really are the private sector prerequisites. So we are saying that in the last 10 to 15 years, government's track record on executing these large projects, and a large number of those were in the kind of Eskom space, their track record had gotten smudged a bit. And that's made private sector investors a lot more nervous about investing in some of these infrastructure projects. And so a lot of firms have stopped allocating assets to Eskom bonds quite a while ago already, because they were not comfortable with the financial management of some of those projects. If we can sort that out in a private public sector partnership environment, you can get the technical expertise onto the project, you can get the financing expertise and the procurement expertise and the oversight. There's actually no reason why pension funds can't invest in many of these, kind of national infrastructure projects where there's a clear user that's willing to pay for the service, but the service is not being delivered because the delivery has been corrupted in some way through a lack of skill or through some type of fraud or corruption or a combination of the above. So that's been a very big discussion that's happened at those forums like NEDLAC. And it's clear that I think all the parties there, government included, understand that we need to move ahead. I mean, we saw an announcement this week, or it was late last week, from Minister Mantashe, that they are opening the gateways for private sector electricity generation and forcing Eskom to purchase this electricity if they can't generate the electricity themselves. That's the kind of steps that you want to see, because those steps open the doors for pension funds to be able to fund some of those private sector partnership projects to, for example, lead to electricity generation with good returns for pensioners. And then the last bullet right at the bottom here that I think is important, worth mentioning as well, the concept of prescribed assets, the worst part of it is this concept that people feel you cannot be forced to invest in something, even if you think, especially if you think the project is not financially viable and is not going to generate good returns. This prospect of being forced to invest something against your will really has worked people up the wrong way. And I think again, from government circles, we're hearing a lot of positive noises in this space where people are saying we need to make this voluntary. We need to make the projects sane and viable, and then we won't have to force anybody to invest in them, because there are no real big infrastructure projects in South Africa. There are great investment options for retirement funds. So if we were to have some of these projects available, retirement funds would voluntarily invest money in those projects. There's no need for anything where you force people to do that. So I think that's the road that we're on. Fix the projects, get them out there, make them financially viable and good investment opportunities. And then that 1 point how much trillion of retirement fund assets that Rob had on the slide would be more than happy to invest in those projects. And the economic benefits for the country from those infrastructure projects will be immense. And then retirement funds and everybody would be making a contribution towards actually removing some of the damage that's been incurred in our economy in the last 10 to 15 years. So with that being said, Paul, I think that is kind of the end of my formal section. So maybe we could take some questions if there are any.
Thank you, Jaco. Rob and Jaco, thanks. Very, very thorough information on this. We did get a couple of questions. Jaco, I'm just going to throw this at you because I think it pertains to what you were saying now. Just from a timing perspective, the question is, how long would it take government to implement prescribed assets?
So prescription of assets, technically in Regulation 28, if they do it using that road, they could do that fairly quickly by making an announcement, because they're not obliged to go through Parliament when you're making an amendment to regulations. So they could do that in a 3 to 6 month period if they really wanted to. Obviously, industry would need to change their software and their portfolios need to be adjusted, and that stuff takes a bit of time to get done. And obviously in that time frame, let's say it's about 6 months, I mean, all of the chaos that I highlighted and the negative impacts and the negative emotions would just ravage the country if that was to happen. But and if someone really wanted to force that through just for retirement funds, it'll take about 6 months. If you were to do it in insurance companies and a couple of other places, it will take longer. Our reading of the Insurance Act, especially the new one, doesn't really make allowance for that. So that means they would have to position a regulatory amendment or an amendment to statute at Parliament, which obviously takes a while to work its way through Parliament, all the debating committees. So that will take substantially longer. I would say probably a year to 18 months.
Okay. Comment from my side then, just to follow on to that, then clearly there is no set date or set implementation time for this, then it is still a piece of discussion.
Well, I mean, to be quite honest, Paul, I think the prescribed assets debates, the people that have been stirring those debates have been people who are on the periphery of the current political spectrum. So those have either been politicians from opposition parties to the ANC, or it's been individuals inside the ANC involved in this proxy war for control with the kind of President Ramaphosa faction. There are no formal plans to implement anything. There is no program. The only discussions that are happening where people are talking about implementation are those conversations that I've discussed earlier at NEDLAC to say, what do we need to do to make it attractive for pension funds to invest in private sector capital? So I think what you are going to see is some announcements like the one we saw from from Minister Manchas last week, where certain areas are being prioritized for investment and regulations are being changed to allow more open private sector participation in some key areas. So electricity generation is obviously one, and we've seen that announcement. I wouldn't be surprised if we see similar announcements in other areas of private sector and public sector partnerships in trying to resolve some key infrastructure backlogs in certain parts of the country.
Okay, thank you. There's another question, Rob, perhaps you're best suited to field this question. Are living annuities protected from prescribed assets in Regulation 28?
Just remember, just paint the picture, as a pre-retirement, at retirement age 55, you then convert your assets into a living annuity. I think the big difference between living annuities and retirement annuities is those limitations. So, for example, you can run a living annuity with 100% offshore exposure. Your equity exposure can also be increased to 100%. So from that point of view, the idea has been flirted around as a solution, assuming you are 55 years or older, to retire into a living annuity and therefore remove those restrictions. But that being said, legislation could be put in place that would also have some limitations on your living annuity. But the overall design and flexibility within your living annuity overcomes the limitations of a retirement annuity at this point in time.
Okay, thank you. To be honest with you, I'm getting quite a lot of questions regarding tax and withdrawal tax. I think that's a larger discussion that a person should have individually with an advisor.
Yeah, agreed.
There is a question, the obvious question which is coming in various formats is, would you advise withdrawing from my preservation fund to avoid prescribed assets? I think, again, there's so many ways to answer that question, and it also depends on outlook, your potential view for retirement, etc. So,
Paul, if I could just maybe chip in here quickly. If we are going down the direction that the ANC seems to be taking at the moment, I would argue that broadening the sort of assets that we could include in Regulation 28, if anything, would improve your risk-adjusted returns for investors. So certainly, yes, prescribed assets where we're forced to invest in a specific project would be a very, as we said, disastrous. But the way it seems to be playing out, where they may actually improve the asset classes that we can choose from, like, for example, infrastructure, I think if anything, that would be a benefit towards your retirement money that has to abide to Regulation 28 at this point in time.
Yeah. And I see we've run out of time, so if you don't mind, I've got one more question. And Jaco, I think I'm going to throw this one at you. It's a little bit of a long question. I get the gist of what the question is asking, so I'm just going to read it if you don't mind. I'm a South African living abroad and non-resident for tax purposes. I'm 48 years old and holding out until I'm 55 years old to draw an SA annuity from my retirement annuity fund at a relatively low tax rate, and also move my portfolio into a non-Reg 28 international equity focused living annuity. Rob, very similar to what you just said now. If I formally emigrate for ex-con purposes now, do I have to withdraw my RA, or would I be able to withdraw when and if prescribed assets are introduced?
So I'm not 100% sure if you are forced to withdraw your retirement funds. As I have it, if you're doing an ex-con immigration, it is optional whether you want to withdraw your retirement fund, but you can. But then once again, if they must remember, we're going to lose the concept of ex-con immigration shortly. So I'm not sure once they remove that, it's not 100% clear what's going to happen with people who have immigrated for ex-con purposes in the past, but who haven't cashed in their retirement funds, whether those vested rights will remain available. I mean, those are small little details that are not 100% clear. But if they are financially immigrated already now, I suspect that what's going to happen in future is that you will still be allowed access to your retirement fund assets if you financially immigrated, but they will use one of those tax tests for being you know, whether you're really in South Africa or not. And there's a lot of case law involving those, and it's quite complicated. So I'm not going to get into that, but that looks at where you live and what you do and what you have and where that's held and where those assets are held and what are you living from and all of that. I suspect that whatever definition they do come up with in future to take the place of ex-con immigration would still allow you to redeem your retirement fund, pay the tax, and take the money overseas. What's going to happen if it's a living annuity, though, is a different story. So if you retire first and then you want to take the money, then obviously those rules change as well. So that's why this is such a complex and technical area, whether you do the immigration before you retire or after. I mean, that sort of thing should really get specialist input on trying to help you understand what the implications are going to be of the different options.
Yeah, no, I agree. I see we've gone a little bit over our time, so I think we need to keep it here for today. Certainly lots to think about. Rob and Jaco, thank you very much for your time and for your insights today. If we didn't get to any of your questions or you'd like to discuss your personal circumstances offline, please contact your Carrick financial advisor or myself to arrange a separate session, and we can go through your individual situation at that time. We're going to end it there. Thanks to everybody for joining us today, and please stay safe.
Thank you.
Thanks, everybody. Have a good evening.
Thank you.
Bye-bye.